Hi, everyone, and welcome to the week ahead. I'm Tony Nash, and we're joined by Nick Glinsman, Albert Marco, and today we're joined by Sam Rines for the first time. Tracy Schuchart could not make it this week. She'll be back next week. So before we get started, I'd like to ask you to subscribe to our YouTube channel. It obviously helps us with visibility, and it gives you a reminder of when a new episode is out. So if you don't mind, please take care of that now. A lot's happened this week. We saw CPI slightly higher than expected, which is what we talked about on the show last week. Consumer sentiment out on Friday, slightly lower than expected. And there were a few things that we said last week that will remind you of. The 10-year cross two, Nick pretty much nailed that. Crude went sideways. Tracy said that we would see a slight pullback and sideways move in crude. The S&P had a slight down bias, which is what we talked about, and the Dow had a slight upward bias, which is what we talked about. So good week all around. Thanks you guys for being so on the spot for that. Let's start with CPI. And Sam, since you're the new guy, it surprised high. So what really jumped out for you, and what do you expect to see with CPI prints going forward?
Basically, the entire print jumped out to me. I don't think there was a single thing that was actually positive on the inflation front, right? There was no positive news that we could extrapolate from there, whether you're looking at the actual headline number, the core number, 3-month annualized accelerating, et cetera. It was a pure CPI hot. It was just hot. Cupcakes and cakes were the worst news in there. Both of those up. I think it was like 2.2%, 2.3% on a month over month basis. The only thing that was a little bit lower that kind of offset that was ice cream. So dessert got more expensive for most of us. I think generally the way to look at CPI right now is we were supposed to have this really interesting handoff from goods to services. And what we really had was no handoff from goods, and services begin to start running, right? So you had people begin to go outside of their homes, but they're also working at home. So you need more stuff. Right. If you have an office and you work from home, you need 2 computers, you need 2 microphones, you need 2 cameras. That's really what we're beginning to see, is the confluence of, the end of COVID restrictions, but not really the end of COVID all at the same time. That's a big problem.
So the durable goods cycle we're late in that cycle, right? I mean, it's not as if we're redoing our homes anymore. Most of that stuff is gone. It's more consumption, right?
Yeah, it's a lot. It is consumption, to a certain degree, but also you haven't really seen a slowdown in people buying homes. When people buy homes, when people build homes, they need to put them. They need to put stuff inside of them. They need couches. They need. That's fair. So I would say we're probably not at the end of the durable goods cycle. We might be in the 5th or 6th inning.
Okay.
But millennials still want homes, right? Millennials figured out that when you can't go to a really cool restaurant in New York City, it's not really worth living in a 1,000 square foot apartment or smaller with a kid, right? They've decided that they really want to go make a household somewhere, buy a house. Right. So I think we're more call it mid innings of the durable goods cycle. And on the services front, we're just beginning to see the reemergence there, right? You're just beginning to see housing costs, housing and rent, et cetera.
Okay, so this inflation cycle is something that Nick and Albert have been talking about for over a year, right, guys? You started talking about this in August of 20 or something like that?
Yeah, something like that. I mean, it was evident as supply chain stresses is going to cause inflation, and when the demand starts to tick up and there's no inventory, of course, it was inevitable at that point.
So when does it end? I mean, obviously, this isn't kind of the transitory inflation we've been told, and that's been said many, many times. But do you see this continuing through? Let's say all things equal, there's no rises from the Fed, nothing else. How long does this go before it works itself out, Nick?
I think sorry, Albert, do you want to?
No, it's just from my perspective, wage inflation is a problem. So until that gets sorted out, inflation it's going to be sticky.
Yeah, with Atlanta Fed wage price level, it was 5%, I think it was, came out for the first time in 20 years. I'm going to be slightly contrarian. I think we're at that peak. Whether we can go up, we can still go up a bit more, but I think there's a peak. And the trouble that people have got to get their minds around is if we're peaking, it could take several months. Where do we come down to? And my suspicion is we come down to a level that's still significantly above the 2% Fed target.
Right.
The other thing that I think is really important, you've got the conventional wisdom, Fed's behind the curve, and now everything, all these forecasts from the street have sort of gone like this, boop, 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 boop. And Goldman have now joined Bank of America on 7. The key thing to understand, in a zero rates environment, they introduced forward guidance, and that was their technique to try and suppress volatility in the markets. Well, now that things have shifted around so rapidly and we're moving to a rate hiking cycle, they're actually not going to be suppressing volatility. By definition, they can't. So that, you hear this in Europe as well. Data dependency. We're dependent on the data. They're dependent on the data in Europe because their forecasts are so terrible. Haven't been much better in the US either, right? So you're going to have much more volatility. So what we've seen in the last couple of weeks, which if you ran money through 2008, is sort of nothing. But what we've seen in the last couple of weeks, get used to it. And I suspect, going back to what we mentioned last week, and I even put it on a tweet, Newton's law of gravity is going to start to impose itself on those stocks without the high dividends, those stocks that don't have the earnings, those stocks that are over-owned. I know we've got witching out next week, or OPEX. Not clear whether the market's long or short delta. Just not clear to me, because actually a couple of days ago, Goldman came out with a chart that showed that short interest on the S&P is really low. So if that's the case, and I maintain that we've got a lot of trap longs still there, this volatility is going to get worse. You're getting volatility in the treasury market. And remember, the treasury market, by definition, in a zero rates, low rates environment, is long convexity. So the price moves for a couple of basis points are way bigger than they were back in the days when you had a decent coupon, back in those good old days where retirees would earn some money on their bank deposits.
Yeah.
So they're not suppressing volatility anymore. Volatility cannot be suppressed, even if they sell VIX. Doesn't matter. We're talking about broad systemic volatility. Is it a risk? Could be, but that's gone. Those days have gone. Forward guidance, they're not even going to forward guide. Powell's last press conference. I'm going to be humble. I can't give you whether it's a 50 or a 25, but we're not. He never said anything. No, when he was asked aggressive questions. So it's sort of interesting.
That is very interesting. I think the not worrying about volatility is a very interesting point. Even if they just dial it down a little bit, it's a very interesting point to me. So let's move in that direction, Nick. There was a lot of Fed speculation this week, obviously more intensive than even last week. Intra-meeting hike, 50 basis point hike, 25 basis point hike, all this other stuff. So what are you thinking about that and QT? I also want to get kind of your and Albert's view, and Sam, of course, on, this thing going around on Thursday about an emergency meeting on Monday. So let's talk about all of that stuff with Fed and central banks.
I just don't think this Fed has it in them to do something shocking. So the first order of business, if they were to do anything inter-meeting, is stop QE. I mean, that's absolutely absurd that that's still going on, right? So you stop the QE. I think, remember, this is a Fed that's built on, most of these members are built on the gradualist approach of the Fed. They've been suppressing volatility. They don't want to shock anybody. So I think there is a valid discussion to have between 25 basis points and 50, but it's a discussion they need to have, and they need time to think about it. Interesting, Bullard came out as hawkish, given he used to be a dove. And we'd forecast that actually everything he said, we got a little experience of deja vu. But I'm suspicious of this inter-meeting situation. The only thing I can think of really would be stopping QE. That's where their first, if you watch the Main Street media, that was their first port of call, all the experts, and they're still doing QE, which is i.e. why they're still doing QE. I think they need a proper, I think right now, given it's a new hike, first hike in the whole they need to have a proper board meeting.
So you think there's a greater than zero possibility that they'll stop QE on Monday? I'm not saying you're saying it will, but you're saying it's greater than zero.
That would make sense to me.
Okay.
It would be a bit dramatic given all the huff and puff that's been in them since last night about this secret meeting, which is not so secret. I would be surprised if they do an inter-meeting. I'm still trying to figure out whether they're biased towards 25 and 50. Remember, the market's giving them 50, but when is the last time the Fed taken what the market's given it?
Albert, what do you think about Monday? The speculation about the meeting on Monday?
Well, yeah, everyone's talking about this, meeting that popped up all of a sudden, and some people are starting to dismiss it, saying, "Oh, it's procedural and whatnot." But realistically, they got together over the weekend to discuss what's really happening. The last time they did something like that was pre-COVID in 2020. Right now the Fed and actually the Biden administration together are looking at problems with the Russian invasion of Ukraine looming. Trucker rally actually in the United States and France and Australia that are looming. Any more supply chain shocks is a systemic problem to the economy, and I think they have to address it one way or another. Whether it's a 50 basis point hike in Monday or March or something, that you're going to have to do something against inflation.
So you think it's possible that they could take some action on Monday? You don't think this is just a procedural meeting?
I don't think it's a procedural meeting whatsoever. I think something's wrong with the system, and they're working to address it.
So if you had to say they're going to stop QE or they're going to announce a rise, which is more likely on Monday?
I think they're going to announce a rise. To think about it, they'll probably stop QE before they actually do a rate hike. I think the rate hike will definitely come in March.
That's the sequence.
Okay.
Yeah. And just to add something there, I think it's really important to remember that, effective Fed funds right now is 8 basis points, right? 8 to 9 basis points. It bounces around a little bit, but we hike in ranges now, right? So we're going to hike from 0 to 25 to 25 to 50 or 50 to 75, and they don't have to put it at the midpoint, right? So it's, going to ranges, so to speak, is not the only way to look hawkish. If you raise one range of, to 25 to 50 and set it at, say, 40, 45 towards the top end of the range, you can do one rate hike, quote unquote, but be pretty hawkish within that range, right? You can show your intention pretty quickly there, which would match pretty closely to what the market expectations are when you kind of extrapolate down to actual basis points, what the market's giving the Fed. So I think it's really important to pay attention to not just, where the range ends up, but where they decide Fed funds goes within that range.
So it could be incremental. They could be a Chinese central bank's type of like 37 basis points or 38 basis points or something.
Exactly. And I think that's going to be the kind of quote unquote the shock and awe that they can use. Okay. Right. They can have call it a very hawkish one hike. They don't need to do two hikes to be overly hawkish.
Okay. So, and what do you think on Monday? Do you think it's a procedural, or do you think it's possible that there could be some sort of policy change?
I think it's procedural.
Okay. Interesting. It'll be interesting to come back in a week and see what's happened with that. I like the differences there.
We get the coins out. Heads.
Sorry, what's that?
We get the coin out and heads.
That's right.
Heads procedural, tails it's something.
Right, exactly. Okay.
One thing it can't be a hike without stopping the QE.
Yes.
Yeah, that's true.
Yeah. Right. Okay. That's a good point. So speaking of inflation, before we get on to the truckers and other stuff, Nick, you guys put out a piece last week about the metals market. And I'm really curious. It looks like there's a view that there's longer term rises in metals, industrial metals especially. Can you give us a little bit of color on that and help us what to expect in metals markets?
Sure. It was a longer term view. It's not really a short term trading view. The view is, so I have this thesis that some of the greatest trades attached to some of the biggest traders in time have arisen because of policy mistake, whether the policy is bona fide or whether the policy was just, malaligned. And right now we're in this net zero push, which is the new neurosis, and there's no transition plan. So the first thing, if we were to look to commodities right now, where is it the most obvious place that it's hit? European energy, right? The Germans getting rid of nuclear. I mean, it's just a complete and utter mess. But it's actually in the metals market where over the next couple of years, it's going to be really keenly felt. There's been a lack of capex, like energy. There's been a lack of capex in metals. They learned what lessons we don't know. Lessons from 2011 when prices were very elevated. And with that lack of capex, and they're paying high dividends, they're rewarding shareholders, means the supply cannot be flexible enough, elastic enough on the upside to meet all this huge demand. So we put the blocks together. China, give or take, is still there as a big user and consumer of the metals. Now you add on the rest of the world plus China, additional China, on net zero products, EV cars, right? All the wind farms, the solar panels, all this stuff needs metals. Some of it needs fossil fuels as well. And I got triggered a couple of weeks ago. There was a report in France that said, in the next 2 years, the available supply of copper, i.e. not new finds or not new mines, the available supply right now will have been used up. Yes or no, but the point is that's the direction. Nickel, even more so. And then you think about nickel and the geopolitics of Russia having a huge nickel company, and what we're about to go through potentially with sanctions. All this geopolitics grinds against the need for these metals in terms of net zero. So there's basically, you've got those two forces against each other, which squeezes everything up in terms of price. And, from the point of view, we have no transition plan. So if there was none of that, we needed a transition plan anyway. So our view, you can go through the metals quite. Aluminium's been making new multi-year highs this week.
Right.
Aluminium being the cheaper copper. So,
okay. Yeah.
Right.
So yeah, I think as a medium longer term plan, as a strategic placement, I think that's very interesting. Let's move on to other components or let's see, uncertainties with what seems to me is a resurgence of populism with these trucker strikes and other kind of demonstrations. Obviously, the Canadian trucker strike has stolen the headlines this week, but there are things happening across Europe, and they have been for a year. Australia has been happening for 6 months, something like that. Demonstrations. You see sporadic demonstrations in the U.S. with talk about truckers striking at the Super Bowl or something like that. So, what do you guys think about that? Is that a real risk, and is that a risk that will flow into markets?
I think it absolutely is a risk. I mean, if you're talking about, adding more stress to the supply chains, of course, it's going to be a systemic risk. I wouldn't even put it past some foreign actors propelling it, through social media campaigns to stress the United States, France, and Australia.
Okay.
I certainly would if I was Russia or China. I would definitely do that.
Okay. So what does that do if there is this kind of wave of populism that is pushing back against kind of COVID restrictions? Do you think that puts more stress on, say, the US government to get fiscal spending out there to kind of placate people?
There's no way we're getting fiscal. That's just, the reasons that the Fed has been doing all the shenanigans behind the scenes is because there's no fiscal that's happening.
Okay.
From what rumors are that they're even buying oil futures.
Okay. So it makes things complicated, right? If you can't send fiscal out to the people, then it makes kind of populism even more complicated.
Of course,
and more acute, right? So what does that say for November in the US? Does that mean that it's going to be tougher than we had thought on Democrats?
Oh, absolutely. They sent out a memo to all the Democratic governors, with all the warning flags that, if you don't lift off these COVID restrictions, we're going to get massacred in November. So all of a sudden you saw this week, like a dozen Democratic governors lift all the mask mandates.
Okay. But do you agree if they had room for fiscal, it would solve some of these populist issues?
Oh, that's a tough question, Tony. I mean, possibly, but then, then the talk of new stimulus checks comes out, and then the inflation problem gets worse. So it's like, what are we doing?
It's a complex problem, which is why I'm asking the question.
Didn't Joe Manchin make it pretty clear though this week? He said, I've been last year with the last fiscal. I said inflation.
Yep.
Then it's off the. I mean, I quite like it. It's as clear as you can be, but he's a swing vote in the Senate. He just said, "We're not dealing with
inflation trumps fiscal." Is what you're all saying? Is inflation trumps fiscal, regardless of what happens with populism?
Oh yeah,
inflation. Yeah, sorry, Sam. Let's make it real quickly. Is like inflation is a nuclear football for politicians.
Well, especially at 7.6%, right? So fuel inflation at 40% year on year. I mean, this is crazy. So, okay, let's move into what we expect for next week. What are you guys looking for next week?
The flattening on the 210s curve will continue until the Fed breaks something and has to go the other way. That's
okay.
I think that to me is the easy trade out there right now is 210 flatten, done.
Put a health warning on that. I'm going to put a health.
Yeah.
If the Fed wimp out, I even think 25 basis points and non-hawkish statement. If they wimp out, that long end is going to get hit, because the idea of a flattening curve, remember, the sequencing is wrong here. That curve flattens after they've, well into hiking cycles because of the potential for a recession. 13 out of the last 14 hiking cycles have led to a recession. That's why a curve bear flattens, okay? It's already doing it. So, but the point is, it's because they think it will be enough. If the Fed, given the narrative now, don't go ahead with this, and I'm still anxious about the Fed, even though Powell warned back when the QE3 was being launched, you're going to create a whole load of problems. Ironically, he got all the problems. I'm just still nervous about this Fed, because
I think everybody is, Nick. I think that's why we're seeing the volatility, because no one's getting a clear signal. And we saw some Fed governors out on Friday saying that 50 basis points is too much and putting 25 basis points into question. So, I think there is I'm not sure if there's a consensus.
I mean, actually, there's a great trade to be had. Great trade in some of the markets. You buy a straddle, you buy volatility effectively. Make it, you usually pay up for premium, but you make it completely not dependent on direction. Because
so why volatility is what you're saying for the next several weeks?
Because they're not going to suppress volatility anymore. It's reversed. So everything they do now is by definition going to be creating more volatility. We've been zero rates, forward guidance. Let's just cruise, and the balance sheet's pushing the stocks up. The other thing you need to watch, by the way, is the level of reserves.
Right.
Because I actually think if back in 19 there was that reserves issue with the repo, I think that's that could be problematic if something like that happens again.
Okay, great, good to know. So let's go one by one. And what do you guys say in equity markets next week? Is your bias for equity markets? Do you have a downside bias in equity markets? Sam? Sorry, Albert, go ahead.
No, sorry. I was just going to say next week, I think it's going to be all about the Federal Reserve's narrative building. It's going to be a choppy session in equities all week. They're preparing you. They're sending out Bullard with ridiculous 100-point basis comments, and they're just preparing you for a 50 basis point rate hike. So that's what I think is going to happen. So we'll just be choppy all next week.
Okay, Sam?
I like SPX more than I like the Dow, and I like the Qs less than I like the Dow. And I don't like, and I don't like any of the three. You believe in
tech. Amid the volatility, you believe in tech.
Oh, no.
Okay.
Okay. I don't like any of them.
Okay,
And I prefer the S&P to the Dow, and I prefer the Dow to the Qs.
okay,
So it's
okay,
sort of like
Yes.
this. Boom, boom, boom,
Yes.
boom. Right?
Yes,
okay.
exactly. I don't like any of them. But if you had a gun to my head and made me buy something, it would be SPX and shorting Qs
Okay,
against it.
so there's a slight downside bias in markets next week, equity markets.
Yeah.
Okay, Nick, same?
I think, as I said, I like what I wrote, Newton's law of gravity. As these rates come up,
Yep,
it starts to put gravity on the equity market, and gravity will bring it down.
okay,
I would one proviso though. If we get some, along the path that we're going, we get some serious shakeouts. I do think what could be interesting is some of these commodity related stocks, because actually commodities do quite well during a hiking cycle.
yep.
Okay, and that's again fits with our thesis anyway. So
Of course, gold has been on a tear for the last 4 trading days.
confusing everybody, right?
Yeah, of course.
Right. Sam, do you agree with that? Commodities as during the hiking cycle?
I mean, I think oil's great during a hiking cycle. If you look back over hiking cycles, oil tends to do pretty well. I actually like the long oil, short gold trade.
Okay, so you bring us into a good point. Oil was my last stopping point. So Albert, Nick, would you guys sit in the same place with oil? You think in the short term, say next week, oil's looking good, or you think it continues to trade sideways?
I think it goes up. I know. I from rumors are the Fed's buying oil futures. I think it's going to go up to 110. Not next week, but over the next.
Even with the inflationary pressure,
even with which is unbelievable for me to even say that. Even with the dollar rising, it's
That's very
unbelievable for me to say this. But
Well,
this is what's happening.
Albert's just made a great point. These commodities are all at new levels, and really the dollar hasn't collapsed yet.
Okay,
It's been in a rising dollar environment. So can you imagine what would happen if the dollar sells off to these commodities?
Yep.
I mean,
guys, we're gonna have to wrap it up there. So thanks very much, guys. This has been great, and have a great week ahead. Thanks very much.
Thanks, guys.
Thank you.